Hi, my name is Josh with Axiom Mortgage Solutions. People often ask me what they need to get approved for a mortgage. There are dozens of factors that impact a mortgage approval, and each lender looks at things a little bit differently. But more often than not, the approval comes down to three fairly basic things. I like to call these the three pillars of a mortgage approval. The three pillars are your income, your credit history, and your down payment. Your income determines how large your mortgage can be. Income normally falls into one of three categories. Those with straightforward salaries or full-time hourly work, those who earn commission or a notable portion of the income is through bonuses or overtime, and lastly, those who are self-employed or are contractors. Most lenders also consider Canada Child Benefit. For those in the first category, your income is very easy to verify. For those in the last two categories, most lenders and banks want to see a 2-year history of your T4s or your notices of assessment or tax returns to establish your average income. Most lenders allow us to use up to 44% of your income to make all of your payments on your mortgage, your property tax, your utilities, and any of your other debt payments. Now, limiting to 44%, what that does is it leaves enough room that you can still make your other monthly obligations like tax, food, fuel, entertainment, etc. Your credit history makes most of the yes or no decision on an application. You could make hundreds of thousands of dollars each year, but if you have poor credit, most lenders will be hesitant to lend you money, especially at the lowest rates or with a small down payment. When we look at a credit report, we look to see if there's enough credit established. Normally, if you have a full year of active established credit, that will be sufficient. Now, once we've established that you have enough credit history, that you pay your credit on time, and that you haven't maxed out the credit that's available to you, we're usually able to move on to the last pillar. And that third and last pillar of a mortgage application is the down payment. Your down payment typically needs to be 5% or more of the price. Your down payment can come from savings, from your RRSPs, or even gifts from immediate family members. In certain cases, employer grants or borrowed funds are also allowed, essentially getting your mortgage with little or no down payment. Now, I know that saving a down payment can be very difficult, especially in the more expensive markets in Alberta, but having a few more options for the source of your down payment can make a big difference. Sometimes, if your credit's damaged or your income's a bit more difficult to prove, you may need a larger down payment. So really, what's the next step? Let's chat. Let's figure out how you can apply or how these apply to you. I'm doing one-on-one Zoom calls over Zoom where I can show you exactly how each of these will impact your approval or your plans to buy a home. So just go ahead and choose a time on my calendar below and we can work together to see how this works for you.